Now we're continuing. We're going to have to change a little bit the order because of unfortunate circumstances. So we're going to start with Professor Dirk Zetzsche, who is a professor of financial law at the University of Luxembourg, where he holds the ADA chair in financial law, inclusive finance, since March 2016. He heads the Faculty of Law, Economics and Finance, House of Sustainable Governance and Markets. He's also an author of more than 300 publications, including some leading articles on fintech and regtech, sustainable inclusive finance, and corporate governance. So he will be presenting his aspects right now on financing sustainability or sustainable finance. So with pleasure, I give the floor to Professor.
Thank you very much, Leila, for your kind introduction. I'll share quickly my screen with you, and then we can continue.
Perfect, we can see the presentation.
You see my slides? All right, good. So, thank you very much for the kind introduction. I have the pleasure to present a piece of work that I wrote with Dr. Linn, Anker, Sørensen, who can't be with us today for some health issues. We have worked for the last year on how to regulate sustainable finance quite intensively. And some of what I'm going to present links to what Alex related to and introduced to us already, how to reconcile what we know about sustainable finance based on existing research with regulation. Let me just start about the topic today. We try to analyze what the European Commission has put out so far on its work program, analyze it and put it into the context of existing sustainable finance research. So when we think about what happened in 2018, with the Sustainable Finance Action Plan, SFAP, there was a clear policy push to make sustainable finance the new normal. And 6 building blocks of regulation were introduced so far. There is the Sustainable Finance Disclosure Regulation, which came into force in March this year, the Taxonomy Regulation, which will come into force in January 2022. Then we have amendments to the Benchmark Regulation, which deals with, in particular, rating agencies and related financial informational intermediaries, and additional pieces of legislation deals with the sales of financial products, the organization of financial intermediaries, and the social responsibility disclosure regulation. In a way, the SFAP addresses 3 different questions: what is sustainable, who is sustainable, and how do we make sure that they act sustainable? And when you put that into this organization, you find that the taxonomy regulation is pretty much of what is sustainable. Then we have a lot of disclosure-related pieces of legislation now coming into force or already adopted, which aim at making sure that everyone has to declare that they are, or to what extent they're sustainable. And then there's a basically 3rd bracket, and that would also be the focus of my presentation, how to make sure that asset owners, asset managers, and distributors act sustainably in that sense. Let me just make sure, because I'm not sure about the legal background that you all have, we have a certain definition of what is sustainable in the taxonomy regulation, and which is now also applicable all through the respective pieces of legislation. There must be a substantial contribution to one environmental objective, and these environmental objectives are defined in the taxonomy regulation. For instance, you must contribute significantly to carbon neutrality. At the same time, you are not allowed to do any significant harm to another environmental objective. Again, an example is when you improve on the carbon side, you cannot do this by sacrificing the biodiversity side. And that brings, for instance, electric vehicles into a big problem, because many of the raw materials used for batteries and so on are taken from the ground in Africa, and they destroy biodiversity and increase other type of environmental harm. In addition to this type of double check, substantial contribution, do not significant harm, there is also a 3rd element, and that is compliance with minimum legal safeguards. For instance, the OECD guidelines for multinational enterprises, certain human rights standards, certain labor standards. So it is not easy actually to be sustainable under that definition, and very few products meet this three-pronged test. That creates some issues, and we will discuss that a little bit later, but just to keep in mind that being sustainable under this three-pronged definition is something the markets currently struggle with. When we now look again and what we want to cover, there we have, of course, a taxonomy, which will be applicable all over the value chain. And then we have certain pieces of legislation dealing with each of these elements of the financial service value chain, from the beneficiary, that is a pensioner, for instance, the asset owner, the asset manager, to the issuer and the developers of the financial product. So in a way, disclosure now works backward. You have the issuers who have to disclose about certain sustainability factors in their materials that shall be read by the asset managers, put into risk and incentive-based strategies. Then we have the same about the asset owners, the insurance companies, and the pension funds, and they shall eventually then be incentivized by a certain demand prompted by beneficiaries who are environmentally conscious. So what is the potential impact of the SFAP in 2018? It is definitely a push towards clarifying terminology, because we all have these data in our mind that it's entirely uncertain what is sustainable conduct, and that's also a big problem that we have in our current research, that every researcher applies a different terminology. Then we aim at ensuring comparability and rendering sustainable finance a new normal, in that sense that everyone just asks questions to what extent a certain financial product increases sustainability. We have certain question marks on the organization, and that's something that I will continue in a little bit. Question marks on the organization of financial intermediaries. So what has to be done inside the firm to meet the respective requirements? Let me just summarize that all of that is basically nudging the financial services industry towards sustainability. It doesn't force it, but it gives strong incentives to deal more with sustainability issues inside the organization, inside the product range, and so on. The difference between nudging and mandatory is crucial for the rest of my presentation. Let me just take a look at now the latest developments of the last year, and to put that into this framework. The EU's new Green Deal, disclosed in December 2019, wants more capital, additional EU program, and basically pushes sustainability from a high to a super high agenda item. And that, of course, is quite interesting. Then we have the IFMD2 review, which was put out in October. And it was a striking difference between the KPIs report on the IFMD2, which was basically disclosed a year or two prior to IFMD2 review. And that was silent on sustainable finance. But the IFMD2 review was now very expansive of sustainable finance. And for instance, we will get some mandatory regulatory reporting template that deals with risk exposures, which is basically sustainability risk in the terminology of the EU legislation, and exposure to climate and environmental risks, in the sense that how are these sustainability risks assessed and priced in each and every financial product. You have further a lot of questions in that contribution or in that consultation, to what extent the EU taxonomy shall play a role when IFMs are making investment decisions. And here we find a lot of basically tools proposed and discussed, which indicate that the EU Commission may come away from disclosure or get away from disclosure and turn towards mandatory regulation. Let me continue in that regard with the April 2021 package, which deals with the financial sector. Besides implementing measures and making disclosure regimes more efficient, they propose to adapt rules on fiduciary duties. And this is something that can't be overemphasized what it means. In the past, you had a fiduciary duty to generate an adequate return for your investor within the respective investment guidelines. Now we will get probably a kind of adjusted fiduciary duty in the sense that it's not just about financial return, but also a type of sustainability return. So the question that comes, of course, is if you have the choice between a more profitable or most sustainable investment, which of the two are you going to take? And in the past, the answer was that depends on the risk you take. If the risk-adjusted return is higher, then you go for the higher return. And we are not yet sure where this discussion will lead to, but we may see this type of return-oriented standard be watered down in the sense that there is a second type of factors to be considered. And that could be the advent of a new mandatory type of regulation, more or less in line of what IFMD2 review presented. And when we now look at what was disclosed in July 2021, there it is, of course, a lot on disclosure because this was a work plan of the SFAP 2018, but you see that there are now additional tools to be considered. And when we look into what this means, then we find that we want to bring in sustainability risks in the capital requirements. To understand what this means legally, when you make a certain asset more costly in capital requirements, of course, you have two chances. Either you don't invest in this asset anymore, or it must be more profitable for other reasons, so that it still justifies investment. So what we do here is we start tampering with the investment streams directly by way of capital requirements. In a similar way, what we see here is that we see an acceleration of contribution of the financial services sector to transition efforts. So the politics expects that the financial sector does not only invest money, but really does basically follow a kind of social purpose. And it does so by a certain commitment. So for instance, the idea is the sector shall commit, we are saving that much kilotons of carbon dioxide. And again, we find here the fiduciary duty elements, stewardship rules. And so in this regard, we see a certain push from the nudging approach facilitated by disclosure into a mandatory regulation. And when you see that as a lawyer, you start thinking about on what basis do we do this type of regulation? Do we have the right data so that we get the rules right? Because as a lawyer, something is very, very well known. There is something like a failure of regulation if we don't get the regulation right. And that prompted in us, the question is, do we have the data to write this type of mandatory regulation that we can really prescribe to the private sector how to invest the money? And you can see from my headline that we are very much in doubt that we have reached this status. We have found out, based on a full review of the articles in the best finance journals that there are on this planet, that we have a lack of experts of consensus on very basic questions. We have a lack of data when it comes to the link between finance and sustainability, and we have a lack of consistent application. And these three elements together, de facto, prompt the risk that regulators are regulating in the dark. That means they're just speculating about things rather than knowing things. Let me point that out in detail. When it goes to the expert consensus, and I think this relates to what Alex said, there is no widely accepted models to calculate whether there's a greenium, that means a premium for sustainable investments. And so in turn, we have a huge variety of results. So now you can believe that you earn money by investing sustainably, or you can just be a non-believer and look at research and get very uncertain results. That is a risk in financial law terms. So what this means is we need further work. We need models that are accepted and that are basically adopted across the market to achieve comparable investment results and predictions. Why is that so important? Well, when we deal with the financial services, that always sounds like we deal with the evil bankers, but we truly deal with is with the pension money of the whole European economy. And when you don't get the pension money right, then the pension system will fail, and then the loss in well-being across Europe is enormous. And just to make an impact here, you can start writing these rules, but you better know what type of rules and on which type of research you base these rules on before you start drafting them. The next problem is that right now we don't have any data on the sustainability impact in that sense. We simply don't have evidence that when we write these rules, we will definitely have less carbon dioxide. It may well be that certain industries cannot be replaced, at least not within the short time frame. And of course, the correlation between profitability and sustainability, a major concern for every asset manager who has to pay out pensions every month, is not clear so far. We have a lot of problems when we want to generate these data, because right now we don't have the key intermediaries in the chain disclosing these data. And so, for instance, when you see a study on green usage, which is the part of the market which commits to sustainable conduct already, then only a third of them, roughly, have disclosed sufficient data in the sense that you can really use them for taxonomy stuff. But even 28 out of the 101 did not disclose any type of sufficient data. Yeah, so it's not even talking about taxonomy, it's just not sufficient for any kind of calculation. And we don't speak here about the broad segment, which will be submitted to the regulation. We're just speaking about the already specialized type of investment funds. What tells us this is that the databases for any type of regulation is extremely scarce so far. And we simply need more data to basically develop good models that we can really say what our regulation will lead to once we adopt it. And this is not a big surprise that we lack the data, because the regulation about which we talk is not yet even in force. And what this means is when we have the taxonomy regulation in force in 1st of December 2021, it will take a full year until it can be applied to accounting. And that means the first set of data that will be out there will be in June 2023. But that's only one piece of legislation, the Level 2 Act on carbon dioxide. We don't even talk about other environmental impact, and let's just also forget the social elements of sustainability. They have not yet been put into legislation. What I want to tell you with this way is, it's not a surprising thing that we don't have data, because the data, the basis of all this data, harmonized reporting, is yet at the infancy. Why do I stress this? Because when we lack the data, regulators are not well advised to do things that can hardly be amended later on. And mandatory regulation is simply different than disclosure. And disclosure, the market can respond. But mandatory regulation really means shift the assets from pot A to B. Then we better know that what it means to shift assets from pot A to B in terms of both sustainability and profitability. And that is also, when you look at the European securities supervisors, the main takeaway, and you would suppose a regulator is usually in favor of very strict rules, but the opposite can be observed here, because these are the supervisors that have to deal day to day with the concerns, and they adopt for a principle-based approach. That means broad principles rather than strict rules. And rather than asking for more rules, they ask right now for a single EU data platform covering both financial statements and ESG information to link the two, which is exactly water on my mills, because we need to know actually what type of sustainability orientation we have already before we can start demanding certain asset flows to be shifted from one aspect to the others. And the third element that we have is an inconsistent application. And that is also not surprising, because the implementing rules which would harmonize the application are not yet even in force and not even written. And we will not write them, at least not the last ones, before 2024, 2025. So all of that looks like too much too fast. And that is, of course, pretty easy to understand when you know what it means to write a law and then integrate it. So these are the 5 steps necessary for an efficient enforcement of certain disclosure rules. We first need to integrate the new standards and our reporting standards. There's, of course, some work in group on the EFRAG level and others where they write these new standards, but simply drafting them is not enough. Then the reporting entities need to build expertise and software tools. Then the information intermediaries, the scoring agencies, the rating agencies, they need to adapt the models. Then the financial intermediaries that make investment decisions need to implement the data from the previous level, and the supervisor then need to draft supervisory guidelines to ensure that all the glitches and difficult questions of little nitty-gritty things are covered. And so this is a pyramid, and you cannot start with level 5 when you have not completed level 1 to 4. And that's exactly the reason why we have inconsistent application so far, and we will have inconsistent application until 2025 or 2026. So it is really a matter of time. We cannot force the future around in the problem world that we are right now. Doing things wrong is basically a risk that we should really consider here. Let me just tell you what happens when we get it wrong. Of course, we will have a certain investor protection concern. And usually when it's just retail, I wouldn't mind so far from a systemic perspective, but we're not talking about retail. We're talking about all insurance companies, all pension funds. And when we get it wrong, that may lead to a systemic risk, because large-scale capital misallocation is something that we can hardly remedy in a short minute. The last time we saw large-scale capital misallocation was in 2009 in the financial crisis, and it brought down the European economy. But that was just a minor glitch in the financial system that needed to be remedied. When we have the full financial services industry oriented towards sustainability, then shifting it around again is simply impossible. So we better know what we do there. And of course, once we get it wrong, the result is not that we achieve maybe just 20% improvement. The true risk is that we don't get any improvement, because what happens is that financial intermediaries will simply delay any type of transformation until they know the rules that they get are well thought through and they actually work. Because one thing is for sure, an unprofitable financial markets is an unsustainable financial market. So we always need to balance those two elements, sustainability with profitability. So what can we do in order to avoid unintended effects of premature regulation? Well, there are certain principles to consider, and there's some research out there telling us what we do when we regulate in states of uncertainty. So first of all, we should avoid anything that is really rule-based and mandatory in that sense, and enhance expertise. Yeah. So for instance, we like firm-wide coaching and training so that sustainability becomes an asset. We hate anything that is very strict in detail in that sense. That means, for instance, in terms of governance, we want to consider the overall impact of existing legislation. And of course, we have a lot of environmental and supply chain legislation already in the making. And all of the impact of that has not yet been internalized. We all know that the firm is subject not only to disclosure rules, but also to all its other rules. And we know that, for instance, the supply chain legislation leads already to adherence to social standards. So that means there is simply something we need a bit of time to implement all of that and understand it. The one thing that I would not start meddling with is remuneration. And let me just give you here an example, which I love to use. And the reason is that legislation is always, to a certain extent, deficient. Let me just give you here an example from the taxonomy regulation. In the first version of the taxonomy regulation, you could, in theory, invest into weapons for mass destruction and be in line with the taxonomy regulation, because it was written in a way that this would have allowed it. So if you now incentivize managers by way of remuneration to go into these assets, then we would get large-scale misallocation in the sense that these type of asset classes will get more demand. That's something that we want to avoid. So when we deal with remuneration, we must be sure that the environment in which we operate is sufficiently predictable that by tying our remuneration to this legal environment, we get the right results. And for lawyers, it is normal that the first piece of legislation is full of mistakes and faults. We should just not pretend that it's otherwise. So 80–90% of the rules make sense, 10 to 15% don't make sense. And there must be a reform, they must be renewed, and then all is good. But that requires time. So don't tie too many legal consequences on something that is not tested and implemented and even adopted in a rush. Of course, what we like to do is a test and learn approach. in that sense. Yeah? Give the intermediary space, ask them to consider these things, give them a premium if they go into experiments, into new reporting models, in new investment models, but don't penalize them when they don't do it. Yeah? That's important. And for instance, when you think about prudential requirements, that is extremely difficult to write and apply. You would need to have a database on what extent sustainability risk really matters. That's easy for some sectors. It's easy for real estate on the Maldives, okay? Because we all know that it will be underwater. But the world is not that easy, that everything is water on the Maldives. There's a lot of stuff in between that needs to be considered and where we simply lack the database for good models. A good model relies on backward testing of the last 5 years. I told you already we don't have this data. So good models need time to be developed. And after we have developed them, then we can start with prudential requirements. The key problem here is what Mark Carney, the head of the Bank of England, dubbed the tragedy of the horizon. We need to incur the cost today, but the benefits will be accrued to future generations. And how do we get there? It's probably better with a strong policy awareness, but a lesser degree of really mandatory regulation, more disclosure and more test and learn. And I would even say that we are facing here something that I dubbed the tragedy of the uncertainty. We have the problem that we are uncertain as to whether adopted regulation results actually in benefits. It may well be that we find out that investing unsustainably in the future is more profitable. And then we need to think about how we remedy the cost. And that may well be tools which are outside of financial regulation. As I said, environmental laws, tax laws, and supply chain laws may be very instrumental in achieving that. But before we have not internalized these effects, it is very, very difficult to tie financial consequences in financial law to these uncertainties. Again, test and learn is right rather than mandatory. So let me just maybe think about also what is the right order. We need to implement the taxonomy, ensure reporting based on the taxonomy, collect data, assess the data, and then start drafting rules and review whether the shift from nudging to mandatory is justified in that the benefits exceed the cost. So what do we need? We need to build expertise on all levels. We need to invest in expertise. We need to ensure a consistent application and retain openness to innovation. All of these are problems we well know of in one financial sector, which is financial technologies. We have all the same problems there. So then look at the fintech and regtech sector, what to do. And what can we do there? Well, we should implement code style, comply or explain approaches. We should emphasize risk modeling and test and learn approaches in sandboxes, draft open standards rather than tight rules, and encourage everyone to test and learn, including the regulators. Let's not admit we know the world from you in this field. We don't know it, but we will maybe go there and come there when we all admit we are in a state of learning. Let me pick up a statement that I saw from Alex. It's not about belief when you write regulation. It's about getting it right, because you impact on the whole sector with one tip of your pen. And before we do that, let's apply caution. I'm at the end. Sustainable finance is extremely important, but because it's so important, it's so crucial that we get it right on the first take. We don't have time to waste for a second, third, or fifth round. For that reason, let's work on comparability and disclosure. Let's remain within the nudging idea and learn more. Give us a bit of time to get it right. Right now, we lack data, we lack a consensus, we lack a less consistency when it comes to applications. But I'm confident that maybe at some point in time in the future, even considering supply chain laws, environmental laws, tax laws that we can adjust, we come to the state where mandatory law may make sense. But right now, we run a high-risk regulatory strategy when we try to take the second step before the first. And the first step is understanding things, and the second is regulating. With that, I'm in the end. We need to mitigate the risk of a regulatory failure, avoid a one-size-fits-all approach to things. Think about that every intermediary also has maybe different functions. we need to wait and see a little bit. That doesn't mean we do nothing, but it also means we need to give the market a bit of time to adopt all of this. That doesn't mean we remove pressure from them to think about sustainability and find good models. But we need to leave room for errors. And that wouldn't happen if we go from nudging to mandatory right now. Thank you very much for your attention.
Thank you very much, Professor. This was insightful. So we go from understanding and trying to figure out the purpose of understanding that we also need the data to support what purpose is and what is profitable right now to kind of determine it. And we see that we're kind of in the dark on as to how to fine tune all the nice principles that we developed. Like, once again, I agree that we kind of really made a nice progress in terms of EU, or at least speaking about it and try to regulate it. But I also agree that the fine tuning process is still waiting for us. I would like to open the floor now for questions. We don't have much time, but still a question or two I think we can take before we continue with the next presentation. Does anybody have a comment, a question? So that we can let Professor go then, because he has other obligations. He so kindly said that he's going to stay with us. If there are none, then you can use contact information of the professor and contact him later on to ask. Thank you very much for your presentation.
Thank you, Lila. It was a pleasure. Bye.
Have a nice day.
Bye.
And now, as we unfortunately don't have the last presenter or one of the first presenters actually, due to health reasons, I will share one of her presentations in the previous conferences because I really believe we shouldn't miss this one out. Professor Linn Sørensen, she's an active professional in the field of sustainable finance. She's working with the EY, presenting pretty much a lot the development of sustainable finance, and her work is as professional and as in the private sector as much as in academia. So I will basically try to share her presentation, and then if you have any questions for her, specifically on her work, you are free to contact me, and I will share her contact details so you can discuss it further, okay? So the last 20 minutes are completely are going to be given completely to the presentation of Linn Sørensen, and then we're going to have a short closure and a coffee break. Okay, so here we go. Enjoy the presentation.
So under the European Green Deal, the European Commission pursues the policy objective to reallocate funds from traditional brown investments into sustainable investments in an effort to finance the sustainable transformation of the European economy. In our paper, we analyze which legal structuring techniques may be useful to most effectively channel funds into sustainable assets. As such, we seek to link sustainable finance objectives to best practice insights from capital and asset management, in particular the securitization and tokenization of sustainable cash flows. We will do this in 3 steps. We will start by laying out how the EU taxonomy identifies green cash flows and show that application of the EU sustainable finance taxonomy leads to the identification of mixed portfolios. Then we will show that a requirement for the securitization and tokenization is, in principle, the ability to identify and segregate the sustainable assets. And finally, we link the first and second insight and consider which techniques will work best to channel funds into sustainable assets as defined by the sustainable finance taxonomy. The various materials on sustainable finance taxonomy introduce key performance indicators for non-financial undertakings and asset managers in a broad sense. Those KPIs, in principle, look at whether the source of cash flows is taxonomy aligned, and then calculate the share of turnover, operating expenses, and capital expenditures created by these green activities in proportion to the enterprise overall activities. These numbers will then be broken down into figures for each of the environmental objective, one of which a sustainable activity must significantly contribute to according to Article 3, a taxonomy regulation. Further then, in a yes or no fashion, Information is given on the do no significant harm requirement according to Article 3 and 7 of the Taxonomy regulation. Since one no in the do no significant harm categories disqualify the activity from an environmental sustainable label, each of the 8 environmental factors must be checked separately. The same then in principle applies to OPEX and Capex, as can be seen on these 2 slides. Each of these reporting templates follow the same pattern just described. The rationale behind the 3 figures is to cover, on the one hand, the current economic activity, but also to take into account investments that further sustainability or environmental sustainability activities in the future while investing in the present. While turnover and OPEX describe the current activities, the objective of looking at Capex is to assess whether the companies have a credible and measurable plan for a sustainable business in the future, i.e., this constitutes a premium for funding the transition in itself. This premium is assigned by qualifying a greater share as taxonomy aligned if the plans for the future, as shown in capital expenditure, exceeds the share of current aligned activities as measured by turnover and OPEX. On the asset manager level, which run diversified portfolios, these numbers are aggregated. This results in a weighed figure as to what extent the portfolio is taxonomy aligned. These aggregations will be part of the pre-contractual disclosures as well as the asset manager's ongoing reporting. Hence, there is an implicit pressure to keep the non-aligned parts of the portfolio as low as possible. It is obvious from the former that this reporting style will split at least medium-sized and large firms, the synthesized conglomerate reporting, into various different sectors according to the NACE codes on which the taxonomy relies. Those NACE codes had so far not guided business reporting, and hence we expect that reporting under the Sustainable Finance Disclosure Regulation in light of the Sustainable Finance Taxonomy will now result in a very granular sectorial reporting. From the investment perspective, that means that investors investing in companies based on the Sustainable Finance reporting will find their investments that are, from a sustainable perspective, a mixed portfolio, understood in the sense that one investment furthers sustainable and unsustainable economic activity at the same time. This trend towards a mixed portfolio is intensified by the fact that some parts of a conglomerate may not be subjected to the same reporting requirements, given that they are located outside of the EEA. Then we will have one part of the investment being green, while others being labeled not green, either because they are not sustainable or also just because they are not reported. The result of that sectorial qualification is then some part of the investments in the company will not qualify as being sustainable. While some firms may structure themselves to avoid the unsustainable sectors, not all conglomerates will be able to do so and still retain their profitability. It would thus be desirable to identify or structure, as the case may be, investment products that are taxonomy aligned, at least to the greatest extent possible. Segregating cash flows for the purpose of focused investments is the purview of capital management techniques, in particular securitization and increasingly tokenization as well. These types of legal structuring with a view to allow investments into the sustainable essence of a conglomerate has gained traction at least since some high-profile transactions in 2017 and will become increasingly important now that sustainable finance taxonomy needs to be implemented and translated into investment flows. So analyzing how securitization and tokenization interact with the taxonomy thus deserves a closer look. From the outset, 2 cases are easy to structure. First, in some cases, almost all economic activities of a legal entity are taxonomy aligned. In this case, the entity with those sustainable activities can just issue securities or even derivatives. These issuance, however, may be prevented in practice often due to the do no significant harm principle of the taxonomy. Further, if the economic activity takes place in a larger group context, then governance or strategic consideration may then prevent the issuance of financial instruments on the entity level. Second, if the sustainable activity is financed indirectly and the financing entity is taking collateral, these cash flows can be securitized, relying on the established modes of a true sale securitization. Naturally, the collateral taker can also just focus on offloading credit risk to investors or an insurance company, relying on synthetic securitization. So some intermediate results. These options do not cover the whole spectrum of sustainable investments. We lack solutions for sustainability-oriented SMEs that are too small or unattractive to receive debt or project financing by banks, and for direct investments into conglomerates with a mixed portfolio of economic activities. So how do we structure investments in these cases? Let me start with the SMEs. Indirect and project financing by banks tends to focus on larger entities. Innovation, however, takes often place in small and medium-sized firms. It is desirable to have, or open respectively, investment streams also for these entities. The traditional solution for SMEs include the activity of venture capital funds, yet the venture capital activity in Europe is, by comparative standards, not sufficiently powerful to fill the funding gap of SMEs. Further, many businesses we speak about do not yield the return expectations of venture capital funds. Another more recent option include SME lending funds. There are some interesting examples of these funds, some with highly digital portfolio management techniques, yet with lending activity not fully harmonized and the regulatory discussions on credit funds on EU level not fully closed, the growth of these funds faces some barriers. A third alternative includes tax incentives and other types of subsidies. While such subsidies would be warranted in cases where the social returns exceeds the investors' private returns, with a sustainable business in the same league as social enterprises, reliance on public spending faces both antitrust and practical barriers in times where public resources focus on COVID-19. So in that conundrum, tokenization may provide an option. While this is not a place to divide fully into the details of crypto assets regulation, even that is one of my favorite topics. So it is here to say that such crypto assets in principle can take the form of an investment security, a payment token, or a voucher-style utility token. For certain tech enthusiasts, tokenization could be attractive, in particular when paired with a sustainability brush. Thus, tokenization could help to overcome the funding gaps observable for innovative SMEs with a sustainable activity. As with regards to securitization, this tokenization can take place via a service provider, for instance, a crypto bank or crowdfunding service provider, subject to the crowdfunding regulation adopted late 2020, or directly also from the issuing entity, if that entity has some tech affinity. It is admitted that regulatory privileges are granted to the issuance of crypto assets only in certain cases, and these privileges will be diminished even further once the market in crypto assets regulation is coming into force. Yet the tech appeal of tokenization may activate an investor base which would not be willing to fund more traditional issues, which will then fill the gap for projects that are too small to activate professional investors. With the SMEs assisted by tokenization, we still lack a solution for direct sustainable only investments into conglomerate where only part of the activities are sustainable, or where for production, governance, or strategic reasons, no outside investments is acceptable for only the sustainable activities. Here we believe that introducing a tracking stock could provide a solution for financing for sustainable parts of the business. Tracking stocks are characterized by the fact that they do not reflect the cash flow prospects of the whole entity, but only parts of the economic activity. They bear similarities to traditional securitization, yet while securitization tranches cash flows horizontally, our tracking stock proposed results in a vertical tranching of the cash flows. Tracking stocks are not entirely novel. They have been discussed in particular in the US literature in the late 1990s. We believe, however, that for direct investments, these tracking stocks, or how we want to call them sustainable share class, could be instrumental in providing a valuable funding tool for the sustainability transformation of Europe. The value of this funding tool, however, stems from creating these tracking stocks in a style and nature designed to fit the purpose. Basic requirements would then therefore include, first, while legal rights over sustainable assets stay with the firm, segregation of the assets for cash flow and insolvency purposes must be assured. We could foresee the assets underlying the tracking stocks are registered and thus the segregation becomes transparent to the public and other creditors, similar to assets subject to securitization today. Second, we achieve the former. To achieve this, we would need a separate accounting flow for establishing the profits that sustainable share class then holds. For small firms, this may lead to a high and unbearable cost. So we would therefore envisage that a simplified bookkeeping structure could be in place, such as minimum interest rate plus a premium based on the firm's overall profits divided by turnover, OPEX, and Capex. While this may mix some brown components into the dividend, this may be acceptable in light of excessive costs for separate sectoral accounting. After all, turnover, OPEX, and Capex must be established on a sectoral basis anyway. And third, governance rights must be carefully considered. We believe that the sustainable share class shall be set up and seen as temporarily, given that it shall accelerate the transformation rather than replace corporate law for good. Thus, we could foresee governance rights for the holders of sustainable share class as defined by the firm's articles of association, yet with more contractual freedom, ranging from a full set of shareholder rights down to what we can be or is granted to debt holders today. Moreover, we would grant a statutory squeeze-out right at fair and market value for the holders of the ordinary class of shares, given that the nature of the sustainability transformation is seen as a project financing. So in essence, the sustainable tracking stocks take the role of a reconvertible loan with additional support in the firm's insolvency. With the insolvency, accounting, and governance dimension being taken care of, the remainder will be left to the markets. We note that, subject to our reading of EU company law, each country's parliament would here be free to establish such a sustainable class of shares. Thus, there is room for experiments and regulatory competition. And for sure, similar to what could be observed in the context of securitization, financial centers aiming at increasing their appeal for sustainable firms may be amongst the first to try and find the right balance between the insolvency, accounting, and governance components just described. So let me conclude. The application of the sustainable finance taxonomy will most likely result in disclosures that show mixed cash flows. Some part of the income source will be taxonomy aligned, others will either be brown business or unreported. In the absence of segregated techniques, sustainability-oriented investors would find sustainable, brown, and unreported income streams. In order to accelerate the sustainability transformation, the application of tools and structuring resulting in segregation of income sources will be increasingly important. In principle, the ability to segregate cash flows is also at the heart of securitization and tokenization of cash flows. Often segregation is given for indirect financing of sustainable assets. Thus, securitization is applied already on large-scale basis for indirect financing, for instance, for securitizing cash flows from debt relations funding green assets. These are various types of project finance, so to say. However, securitization works less well for refinancing equity. Some assets may not be segregated because they are tied into the production context, and SMEs usually do not receive project finance on a scale that is worth to securitize. With regard to SMEs, tokenization provides one additional option, given that sustainable tokens has a great appeal among certain sustainability-oriented retail investors. In particular, tokenization with a scheme similar to crowdfunding in function, if not in name, could be instrumental in reducing the funding gap for SMEs. For direct investments into conglomerates with a mixed portfolio, the introduction of a sustainable tracking stock could provide a solution that specifically tracks the sustainable part of the business. Such a sustainable share would require true segregation in insolvency, while the governance rights could be similar to that senior debt holders and the issuers' residual shareholder rights, so that the residual shareholder retain their rights to buy back the sustainable shares at market price to allow for the flexible restructuring of the firm in the future. In this way, the sustainable finance transformation would further the rethinking of the one share, one vote idea that determined official EU corporate law thinking since early 2000s. And with this, I thank you for your attention.
I hope you all enjoyed Linn's presentation. Much to my pleasure, she's not only expert in sustainable finance, but she's also an expert in crypto assets, which hopefully is going to be one of the topics for our next year conference, where I would really like to explore the intersection of AI and sustainability and how we can use tools that we are developing or that are already developed for pushing forward sustainability. That being said, if you wish to address any questions or comments to Linn, you're feel free to contact me and I will forward the question or the comments to Linn and she will respond as soon as she feels better. At this moment, I think it's time for our break, if I'm not mistaken. Just give me a second. Okay. I think we came to our break. We are gonna continue at 12:45 with our next session with 4 excellent presentations that are still waiting for us, and then with some final notes and some closing remarks. I wish you a pleasurable coffee break. We all could use some minutes for some refreshment, and I'll meet you right back here at 12:45. Thank you, everyone.